The subprime fiasco, which nearly unraveled the entire quadrillion-dollar derivatives garbage scheme which almost entirely collapsed the financial system, was not eliminated after the crisis. It was simply swept under the rug. It has been hidden. Well, now, if we are brave enough, we can follow the money and see where the risks lie, where the next potential dangers exist, and where we need to draw our attention to. But don't worry, the Fed has your back, right? You came here for the truth, so let me unveil that for you. Today we are going to look at the financial system and what is beneath the surface. Let's begin by taking a look at this article out of Bloomberg that's talking about shadow banking. And that's going to introduce the subject for today. It's larger than the world economy. It poses risks to financial stability, and its name conveys a sense of murkiness. Shadow banking. It's a catch-all phrase that encompasses risky investment products, pawn shop and loan shark operations, so-called peer-to-peer lending between individuals and businesses. Even art dealers like Sotheby's have become shadow banks, making millions of dollars of loans to clients buying masterpieces. The common denominator is that these products and practices flourish outside the regular banking system and often beyond the reach of regulators. This is going on today, right now, in 2018. I'm not making reference to 2007 and beyond. This here is happening now, and it is beyond the regulators, as they suggest here. The most devastating runs of the 2008 financial crisis were not on bank deposits, as happened during the Great Depression, but on shadow banks such as Lehman Brothers, a broker-dealer, and money market funds. Shadow banking proliferates for a reason. Free from the shackles of regulation, it gets money where it's needed. Now, that was a long way to say that what happens in the shadow banking industry is simply a way to get around all of the rules and regulations put into place to make this safer. And of course, they're not going to play with those games. If people want to borrow money, they're going to be able to get it. In one way or another, they'll find it. Now, you're not going to get the best rates, maybe. You're not going to get the best terms, but there's a way to get your money, and they're doing so right now. That brings me into my next point. In the years leading up to the 2008 financial crisis, mortgage lenders fueled the housing bubble by issuing loans to high-risk borrowers. But instead of funding the loans by tapping deposits, as banks have done for generations, many lenders borrowed against lines of credit and then sold mortgages to investors. Doesn't that sound like a fantastic idea? You don't even need to do the conventional method, which is already a risk. All you need to do is borrow against a line of credit. Oops, the crisis hit and many lenders collapsed. Now the housing market is strong again, supposedly, and the successors to those eager financial institutions known as non-bank lenders, remember that term, have quickly become the largest source of mortgage lending in the country. The growing dominance of these firms, including Quicken Loans, PennyMac, and Loan Depot, is raising concerns among analysts, academic researchers, and government officials about what could happen if the housing market collapses again. And of course, it's only a matter of time. Maybe it won't come down by 50% or 80%. Maybe it's 30%. Maybe it's 40%. Who knows? But it doesn't really matter as long as it's enough to trigger failures. It's going to be devastating. Although observers say that non-bank lenders today are probably not engaged in the sort of risky lending that dragged down their predecessors, the business model still makes them vulnerable to a housing market downturn. Well, don't worry about it. We haven't investigated. We haven't done any due diligence. But if they're not doing it, then everything is just fine. That sounds about right. These days, Wells Fargo and Citigroup are unlikely to make a $14,000 auto loan to a borrower with a subprime credit score. That is now the domain of direct lenders such as Exeter Finance, based in Texas. So these companies exist today to be able to bridge the gap in between individuals who want to borrow money and getting what they need. But where does Exeter get the money to make subprime auto loans? From Wells Fargo and Citigroup. They have helped them get $1.4 billion for that very purpose. Billions of dollars. And I'm going to go in and show you some more of these details. It's not small business here. Bank loans to Exeter and other non-bank financial firms have increased sixfold between 2010 and 2017 to a record high of nearly $345 billion, according to the Wall Street Journal. They are now one of the largest categories of bank loans to companies. Imagine that. We're talking about risky loans here. This is individuals who can't go the standard route. So they have to go about it this way. Not a good thing. There are higher chances of default, higher chances of bankruptcy. When you have this, you start to encounter failures in the derivative products, and it begins to unwind them, and the balance sheets will start to look very, very bad very, very quickly. So these are the details here. I have some charts to show you as well, but I think you get the picture of what I'm trying to unfold for you. Billions upon billions of dollars of higher risk loans are being generated not by companies like Wells Fargo and Citigroup. There's a middleman company that this system really relies on today to keep the engine going. Banks say their new approach of lending to the non-bank lenders is safer than dealing directly with consumers with bad credit and companies with shaky balance sheets. I don't know how they came to that conclusion, but of course the banks are saying it, so I definitely believe it. Yet the relationships mean that banks are still deeply intertwined with the riskier loans they say they swore off after the financial crisis. I have been saying this and screaming this since the very beginning of this channel, since I wrote my book, when I said that the risks that they were taking never stopped. It's just different in a way. It may not be the exact same reason that we collapse next time around, but ultimately there's going to be something that occurs that triggers it, that eventually brings the system to its knees. Loans to non-bank lenders got several banks in trouble during the crisis. During the housing boom, banks thought that they unloaded the risk of subprime mortgages to other institutions through the collateralized debt obligations. Everybody's favorite, my favorite, wrote about it in my books, CDOs. You get the CDO squared, CDO cubed. You got so many CDOs in this gumbo that they've created. Or vehicles known as conduits, even more ridiculous. Yet in the stress of the crisis, they found the risk landed back with them. It's very easy for people to deceive themselves over whether risk has migrated. And of course, that is an absolute fact. Very happy to see this information making it in the mainstream. This is out of the Wall Street Journal, but there's absolutely no possible way that this will ever be brought to people's attention. It's being put out there, which is great, but it won't be brought to the attention of the individuals because, of course, it's scary, it's frightening. Banking the non-banks. The biggest US banks have made billions of dollars in loans to non-bank lenders. At the top of the list, Wells Fargo, and you could see under that Citigroup, Bank of America, JP Morgan, Goldman Sachs, Morgan Stanley, and the list goes on. So the most exposed here is Wells Fargo, so we'll see what happens during the next crisis. Who knows who's going to fail? Ultimately, they're just going to get a bailout again, so we don't have to worry about that apparently. Loading up on lenders. Bank loans outstanding to non-bank financial firms have surged to a record. We've been told everything is just fine, but what do? They just find another method to increase their profits. They had to do this, or else the corporate profits would suffer, and God forbid you couldn't have that. So we're looking at hundreds and hundreds of billions of dollars worth that has been continuing to plague this system, and most people, they don't even know it exists. Big bank play. Outstanding loans to non-bank financial firms for the biggest US banks, Wells Fargo, Citigroup, Bank of America, JP Morgan. You could see all those in this chart for yourself. Wells Fargo at the top of the list. But it doesn't necessarily mean that Wells Fargo is the riskiest. Who knows who's carrying what kind of garbage on their balance sheets, off their balance sheets, all kinds of derivative products, all kinds of nonsense that's happening right now. So let's look at this. Where are the world's riskiest shadow banking assets? You can look around the world, whether we're touching on Luxembourg, Cayman Islands, China, or the fact that the US has 1/3 of the total riskiest shadow banking assets. But we don't want to focus on that because people get really scared, and of course the Federal Reserve will be there to backstop any losses, so we don't ever need to worry apparently. Well, suddenly I happen to feel that there may have been a crisis back in 2008 that the Federal Reserve was around for, and they didn't fix the problem then. They watched assets fall by over 50%. They watched institutions failing. Countless individuals went bankrupt. Countless individuals became unemployed. And all of those disastrous effects were present, and the Federal Reserve was there. Were they out to lunch? Or are they purposely creating a crisis to then dominate individuals with more power, more wealth, and control? You tell me. If you found this video informative, please give me a thumbs up. When you give me a thumbs up, you're supporting this channel, so I do appreciate that very much. And last but not least, if you want the financial education you were not taught in school, these two books have it all. You can get everything you need to know in these two, everything from the foundation to the asset class, making money, tax incentives, and so much more. Check them out at the link in the description. If you're more interested in the audiobook version, you can get that at themoneygps.com.